Hey everybody, what's up? I'm Professor Martin. Welcome back to Managerial Accounting, where we are going through basic concepts in managerial accounting. You know, all the stuff you'll find in chapters 1 and 2 of really any managerial accounting textbook. Our video right now, we're going to talk about product versus period cost. And you know, one of the tricky things about managerial cost accounting is we have all kinds of different ways that we label a cost. We could have a cost and it could be labeled 2 or 3 different ways. And so we'll shed a little bit of light on one classification, the breakdown between a product cost and a period cost. Now, if you remember back to our last video, we talked about the idea of a total product cost or total manufacturing cost. We take our direct material, we add in our direct labor, and we add in factory overhead. We put all that together and we come up with the cost of our product. A very important thing to know if we're selling products and making products. We've got to make sure that we price them in a way to cover all the costs we have involved and also make a profit. So when we do that, when we make a product, like Nike, we used the example, making a sneaker, when it's done, it goes into inventory and it's carried on the balance sheet as inventory. We can see Nike's balance sheet right here. Those product costs, when the product's done, thrown into finished good inventory, we can see $8.4 billion worth of inventory right there at Nike. And then when it's sold, when that product is sold, or whatever product they made is sold, it gets moved over to the income statement, doesn't it? We can see that reflected in cost of goods sold or cost of sales. And now we also have some other cost. And the cost of goods sold is what it cost us to make the products that sold. But then we have other costs involved with running the business. Nike has something called demand creation expense, which is a fancy way of saying marketing expenses. And then they have operating overhead expense, and lump those two together, you get total selling and administrative expenses. So those two items right there are non-manufacturing cost. Cost of goods sold, the manufacturing cost of what was sold. And these are just things we need to run the company. Doesn't really have anything to do with the product being made. All right? So right there, we can kind of see a breakdown of cost. And that brings me to product versus period. The product cost. What does it cost to make the product? Direct material, direct labor, and overhead. We carry that product cost on the balance sheet as inventory until the product's sold. And then as we saw, we also have period cost. The cost of running the company. We can't really assign that to any specific product. All right, those aren't assigned to the product. Those are selling and administrative costs. Management, marketing, accounting, stuff like that. Those are going to be expensed on our income statement as they are incurred. All right, so we look at the Nike income statement one more time here. You can see right there, we have our cost of goods sold, the product cost, that has basically gone out the door, stuff that we sold. And then we have our non-manufacturing costs. These are usually pretty significant numbers. As we see, Nike, 7.9% of revenue spent on marketing. 24% of revenue spent on operating overhead expense. And usually on your income statement for a manufacturer or a retailer, cost of goods sold is going to be the biggest expense, usually by far. All right, but that's not to say that these other selling and administrative expenses are anything to sneeze at. They're usually pretty substantial too. So to summarize all that, put all that together, we can divide our cost up between product and we can divide them up between period cost. And so we see we got product cost. When they are incurred, they are thrown into inventory. We'll talk about work in process inventory and finished goods inventory later on. But right now, just be aware, our product costs are carried in inventory until they are sold. Until that inventory is sold. Then it gets moved to cost of goods sold on the income statement. Then we have period cost. Selling, general, administrative cost. Normally, those are just going to go right to the income statement in the period that they happened in. We do have some that we capitalize, fixed assets, property, plant, and equipment. we would capitalize those and depreciate those, so the cost of those eventually end up on the income statement as well. Product cost and period cost. Just a way to break down and look at it kind of from a financial statement standpoint. If you have any questions about that, or if you have any questions about any of the wonky managerial accounting topics that we go through, I'd be happy to help. Feel free to reach out. We'll have another video where we come back and we're going to look at prime cost and conversion cost. Yet another breakdown of cost. So hope to see you back here for that. Until then, take care, everybody.